Hi, everybody, and welcome to this quarterly update. I'm Sumera Abdi, and with me is Gaurav Mehta, the Chief Investment Officer of our alternatives business. And to begin, I think from Gaurav and myself and all of us at SBI Funds Management, we wish you a very, very happy new year, right?
Absolutely. Wishing all our investors a very happy new year.
Okay, but we've had a great run. But the one thing that everybody wants to know about is what's coming in 2025. So, what is it that you're looking out for? What are going to be the big themes, big moving pieces?
Right. So I think first of all, let me be very clear that when we are constructing our portfolios, in most cases, we are looking at 3 years and beyond. So to that extent, what's happening over the next few months or quarters is not something that we build our portfolios around. That said, I think it's always good to keep a context of the market in mind. And before I talk about 2025, if we look back on the year 2024, you'll see that it was almost a year of two different halves. And in the initial part of the year, you had a lot of optimism in the markets. So you had a lot of these cyclical sectors do very well, whether it's defense, whether it's railways, whether it's industrials, PSUs, PSU banks, metals, and so on. But when you look at the second half of the year, a lot of these sectors have actually taken a back seat. If anything, many of these stocks have corrected quite significantly from their highs. And on the other hand, consumer, healthcare, IT, I think those are the sectors that have started to do well. So there's been some sort of a defensive shift from a sectoral standpoint. Similarly, when you look at style performances, value stocks were doing very well in the initial part of the year, but in the second half of the year, you saw quality starting to stage a comeback, which again tells you that the markets have undergone a bit of a defensive shift. And similarly, when you look at the market breadth was very strong in the initial half of the year. A lot of stocks were outperforming the indexes, but that breadth has now started to weaken somewhat. So I think from all points of view, whether you look at sector performance, whether you look at style performance, whether you look at the overall market breadth, it looks like markets have taken somewhat of a defensive tilt. And when I look at our asset allocation framework and use that to sort of justify this, we think there were three things that were happening, till about the middle of this year. A, valuations were very expensive. That meant that you should see some consolidation, which is what you're seeing now. B, equity market sentiment as measured through our proprietary framework, that had suggested very stretched and very euphoric market sentiment levels, which again needed to ease off. And I think through this process of consolidation and this defensive shift, that's happening, which is a welcome change. And thirdly, on earnings, you've now started to hit a bit of a slow patch. And this is also leading to analysts downgrading their forward-looking earnings estimates. So this combination of slow near-term earnings, expensive valuations to begin with, and a stretched market sentiment to begin with, I think is leading to this defensive shift. And heading into 2025, we think that some of this ease off will continue, and to that extent, you may have a few more weeks or months of this consolidation before things start to turn better. But I think for long-term investors, and which is I started by saying that we look at 3 years plus. For long-term investors, the interesting piece is that you're still in a very constructive earnings cycle, and we measure the earnings cycle through a simple ratio: corporate profits divided by India's GDP. And this ratio was constantly rising between 1999 and 2008. And that 8-9 year period we remember as a very good period for Indian equities. Between 2008 and 2020, this ratio was constantly declining. So profits growth were very anemic when compared to nominal GDP growth. And we know that was a period which was a bit of a lost decade for Indian equities. And it's only since 2021, over the last 3-4 years, that you've again started to see a reversion higher in this ratio, which is that profit growth has again started to outpace nominal GDP growth. And that gives you sort of, gives you hope that you're still in early or maybe mid stages of that earnings expansion cycle, which usually lasts 7, 8, 10 years at one go. And which is why from a 3 years plus point of view, we still think that you will have relatively decent earnings growth, and that should continue supporting equities. So yes, I think time to be a little patient from a here and now point of view, but the long term continues to look attractive.
So the crystal ball continues to look optimistic. Gaurav, now let's talk about SBI AEON Alpha PMS. Here the manufacturing theme has worked out very well. So we've had all this Make in India, PLI scheme, etc., which have played in your favor, right? But now, probably things are slowing down a little bit. So therefore, how will the investment strategy here evolve?
Right. Uh, so again, I would start by saying that when we are creating these portfolios, we're thinking 3 years plus in terms of investment time frame. Uh, I think from a 3 year plus standpoint, there are three themes that we are very positive on. The first, as you rightly said, is manufacturing. Manufacturing can mean direct manufacturing plays. It could mean industrial companies supplying to those manufacturers. It could mean good quality lenders lending to those sort of manufacturing companies. So that there's an entire ecosystem which we continue to be positive on. And again, there are reasons apart from China plus one. India's economics, for example, is much better than some of the global competitors. You have the right demographics to keep sort of supplying that labor pool that's needed for manufacturing. There's a lot of effort from the government's part, not just on PLIs, etc., but also the fact that they are focused on keeping the cost of capital low. So all of that, I think, will help sort of take India to the next level with respect to manufacturing. So that's one theme that we continue to be positive on. You're right that there'll be ups and downs in this journey, but I think on a secular basis, this is something that we continue to like. The second theme that again you will see a dominance in the portfolio of is this entire rising per capita GDP plays. We are at $2,700 of per capita GDP today, and global experience suggests that whenever economies move from $2,500 to $3,000 of per capita GDP, you see two things: A, there is a disproportionate increase in discretionary consumption, and B, as you earn more, you also save and invest more. So savings and investment related plays also start coming into play. And then the fact that India's population is so young, I think digitization also becomes a related offshoot. And the third theme that we also like, and which at this point looks like a little counter consensus, is this entire natural resources and physical assets complex. Because I think we are in a world now where governments all over are focusing much more on fiscal policy to drive the economic agenda rather than monetary policy. And when governments do fiscal expansion, they essentially end up investing in creating infrastructure, in creating roads, ports, railway networks, and a lot of asset creation happens. And that we think is an environment that is conducive for physical assets and for natural resources that go into creating these assets. So I think those three themes, manufacturing and related plays on rising per capita GDP, and physical assets and natural resources, I think are the three themes that we continue to like from a longer term standpoint. And that's what you will see, a majority of the portfolio is also positioned around. That said, when we are picking these companies, we are very bottom up in nature. We are creating concentrated portfolios. So we're not thinking of what's there in the benchmark with respect to sectors, etc. But this top down thinking married with bottom up stock picking is something that leads to the final portfolio.
Okay, fair enough. But this is a portfolio which has had a very disciplined approach, right? Over here, the stock churn is very low. So, not a lot of stocks are being sold. But when a stock needs to be sold, what would be the trigger for that?
Right. So I think we think of this portfolio as a combination of core and satellite. So at this point, a little over half of the portfolio is core stocks. These are stocks that we want to own for the very long run. Right? These are essentially companies in sectors which have secular tailwinds, managements that have navigated cycles well, and there is a moat around the business. And a little less than half of the portfolio today is in what we call satellite companies. These are companies where we're playing a cycle or a change at margin with respect to the underlying fundamentals of the company or the micro sector or the broader sector. And these are companies that we may not want to essentially own for the next 10, 15, 20 years, but we are happy to play them for a 2, 3, 4 year period to play a certain part of the cycle. Now, when you think of churn, it's satellite where churn is usually higher than core, because core are long-term ideas, you don't need to churn a lot. That said, both these buckets are very active buckets for us. We are not passive in either of them. And if there is a change which happens because of a disruption, or a change that happens because of a management misstep, right, on corporate governance or capital allocation or otherwise, then we immediately act, irrespective whether it's core or satellite. In satellite, what you also see is that sometimes you've played that cycle, you've made your money, valuations have re-rated, and then you want to exit and move to the next bucket. So in that sense, there's that added degree of churn that happens in satellite. But otherwise, we sort of, all decisions that are happening and all stocks, whether it's core or satellite, that are part of the portfolio today, are very actively monitored, and we make course corrections as needed.
Gaurav, thank you so much once again, and we wish you all the very best for this year.
My pleasure, Sumera. And once again, I would want to wish all our investors a very happy 2025. Thank you.